Hello, folks. Welcome back to the Edupedia world, and I am Abhinay Gupta. So today again we are continuing with the standards in auditing, and the standard under consideration is SA 570, the going concern. Right? So we have already had a lecture on this standard. So this is the second and the last lecture on this standard. So if you have missed out on it, please go back to the previous lecture. Right? It is SA 570 first class. Right? So once you are done with that, please come back to this and we will begin with the lecture here. So I'll give you a gist of what we have covered in the previous lecture so far. So in the previous lecture, we have talked about the objectives of this standard, objectives of the going concern. We have also talked about the scope of the standard, which covered the going concern assumption, the responsibilities of the management and the responsibilities of the auditors. Right? Apart from that, we had also started with the requirements and covered the first 5 requirements, that is about the risk assessment procedure that the auditor follows and the related activities that it undertakes for evaluating the management's assessment, right? And also the period beyond management's assessment. You will ask the management, right, what about the period beyond your assessment? What is there any impact on that? Is there any uncertainty? Then we also talked about the additional audit procedure that the auditor would follow when the events or conditions that would impose a risk on the going concern is identified. And at last, the last point we covered is the audit conclusion and reporting in such circumstances. Right? Today we'll move ahead with the other 5 requirements and then deal with the last 5 factors that may cast the doubt on the going concern assumption. Right? We'll take the examples for them. So the basic remaining 5 requirements are: number 1, the use of going concern assumption appropriate but a material uncertainty exists. That means that the management has used the going concern assumption for the preparation and the presentation of the financial statement. Agreed. That is appropriate. Okay, we have also seen the procedures, we have seen the background, we have dealt with the entire audit, and we find that okay, the going concern assumption that you are taking, that you will continue for the foreseeable future, is certain. Right? We agree with your conclusion. But there is a material uncertainty that still exists, and so the management has plans to deal with it. Right? So we will check, as an auditor, the first priority that we will have is to check whether the financial statement will describe those events. Right? Are those events disclosed in the financial statement? Because when they are issuing the financial statement, they will have to disclose that yeah, there are these events that may pose an uncertainty on the same. Plus we'll also consider what are the management's plan. Right? For this, if we again take the same example, right, that there has been a litigation that was against the management and management paid 1 crore 2 crore rupees for that, and there's a problem with liquidity, so that is a threat. Although they will go accordingly, the going concern assumption is correct, right? They're operating very well, no issues with that. They have the regular suppliers and the customers in place, the production is going on in position, everything is fine. The only problem that has come up now is that they have the liquidity issue. But still we would consider the going concern assumption because they have plans to deal with this condition, deal with this situation. Right? So we'll see whether the management's plan is appropriate, like in the example as we have seen in the previous lecture. So if somebody of you who are not able to relate to the example, please refer to the previous lecture. Right? And all I want you is to go back to the lecture, complete it, and then come to this, because when we are talking about this standard, we will be linking both the classes. So it's a request, if you have not seen the previous lecture, please go watch that lecture and come back over here and continue it from this place. Right? Okay, so we'll continue with the example. So over there, what we had seen, that the management had some plans, that okay, the MD's wife is bringing in some funds, we have some investors who are pulling in some funds. Right? So that is the plan of the management, and we will assess that plan. Right? And then we'll see whether there is any uncertainty that the management will not be able to realize its asset or will not be able to pay off its liability. Right? We'll have to assess that uncertainty also. Now when we talk about realization of asset, we can also include the debtors over there, that they will not be able to realize the debtor, there will be a bad debt. So that is an issue with that. right? So basically what this requirement is, that you will have to consider that the going concern assumption is appropriate. Okay, it is appropriate, but if there is a material uncertainty that is existing, what will you do? And we've already discussed what are we going to do with that, right? And finally, to conclude, if you see that yes, there has been adequate disclosure in the financial statement, you will also disclose it in your report. How? By giving an emphasis on the matter paragraph, that yes, although everything is going well, but there is this uncertainty that has existed, but management has plans, so no need to worry, everything is going well, right? But if you see that they have not disclosed the fact in the financial statement, then you will again consider the impact on your report, whether you are giving a qualified report or an adverse report, or what kind of report you are giving. Correct? That is the requirement. Next, if we see, we have the use of going concern assumption is not appropriate. That means the management has prepared the financial statement based on the assumption of going concern, right? Everything is good for the foreseeable future, we are continuing for the next 1 year, so let us prepare a financial statement according to that. This is the position of the asset, this is the position of the liability, we are operating, we are having this cash flow, inflow and everything. All those things have been done. But then when you went to the background to test that the assumption made by the management, whether it is correct or not, you found out that that procedure the management has followed, that was inappropriate. And when you followed your procedure, you found that the conclusion that the management has arrived at, that the company would go for a foreseeable future, is again not appropriate. That means there is a doubt. That means the company may not be able to continue for the foreseeable future. And hence, the financial statement was supposed to be prepared on liquidation basis. So either you request the management to prepare it on liquidation basis now, or if they still continue with the same thing, you will have to issue an adverse report. There is no other option with you. You will not qualify it. You will issue an adverse report, because the entire financial statement goes for a toss. The basic assumption of the financial statement is wrong. So the method of preparation is wrong. Right? So there is no specific area that you say that okay, it's a qualified thing, this area has a problem. No. It's an adverse report. The entire financial statement has a problem now. Agreed with that? Understood? Now next, there is one more situation, that now the management is unwilling to make its assessment. They say we are not making any assessment. So what do you do? If the management is not making the assessment, you will have to see the impact and then decide your impact on the audit report that you issue. Right? So first what you'll see is whether there are any event or condition which constitute a material misstatement. If they are, and the management is not assessing it, you'll have to qualify. That no boss, there is material uncertainty. If it is material uncertainty, then you may also have to issue an adverse report. Right? Then you will also have to check whether the use of the going concern assumption is appropriate. Because if management is not making assessment, you will have to make. And you will check whether it is appropriate. If you find it appropriate, you will remain silent. But if it is not appropriate, then it is an adverse report. Because if the assumption is inappropriate, we have seen in the previous requirement that we need to issue an adverse report. Right? And then we'll see that okay, if it is a little inappropriate, or if there is a little uncertainty, it is appropriate, assumption is appropriate, but there is uncertainty, we'll ask the management to disclose it. If management discloses it in the financial statement, we will just give an emphasis on matter paragraph. But if it does not disclose it, we will have to again qualify. Right? We'll also have to judge the adequacy of the disclosure if they have disclosed. Is it adequate? Adequate? Okay. If it is not adequate, we'll have to inform the people, right? How do we inform? It is not always about emphasis on matter paragraph. That is when everything is correct, still you want to inform. But in this situation, there is something going wrong. So you will have to qualify the report. Right with that? And before that, if you deem fit, you can also communicate with those charged with governance. That listen, management is not ready to listen to us. The management is unwilling to make its assessment. Right? So we have come to you. Do you have a way out? Are you going to perform any procedure? If yes, do it as soon as possible. And even if you are not going to do anything, we will have to take the impact on the report. So you will go and warn the TCWG. So listen boss, things are not going correct. Either correct it, or let us say that it is wrong. Let us assume it is wrong. Right? That is what you take the impact on. Finally, if you find any delay in the approval of the financial statement, so the management is not approving the financial statement, there's a delay, right? So what is the reason for that delay? That could relate to certain events or conditions that is affecting the going concern assumption. So they're trying to amend it, but they're not able to amend it, and hence they're not able to approve the financial statement. So you will have to consider the impact again. You will perform the additional procedure that is necessary to evaluate what is going wrong. Is everything fine? And then in your evaluation, in your process, if you find out that there is a big doubt on the going concern assumption, then again you take the appropriate impact on your report. Right? So far we have talked a lot about, okay, if it is going concern, if it is not going concern, if it is appropriate, if it is not appropriate, if there is a condition that says it is inappropriate, is it material, is it immaterial? We have talked about those things a lot now, right? So it must be a little bit of a mix and match in your brain. What are we talking about? Everywhere inappropriate, appropriate, these things. Let us now put it down into examples. Right? When we talk about inappropriate assumption, when we talk about the going concern assumption to be going for a toss, right? When it is not appropriate, when you are not able to take that assumption, when the balance sheet is supposed to be made on the liquidation basis, right? So basically we need to understand what are the events, what are the conditions that may cast doubt on the going concern assumption that we have been talking about since the beginning of the standard, right? So let us take those examples. So basically when we deal with the events or conditions that may cast doubt about the going concern assumption, we divide them into three different categories. One is the financial level, second is at the operating level, and third are the other miscellaneous things. So basically there are two divisions, financial and operating, and rest all of the things are combined and kept in the other category, right? So let us see what are those financial events or conditions that may cast doubt about the going concern assumption. So financial, the net liability or the current liability position of the company. If you find that their net liability is too much, they will be able to realize that their assets, but they will not be able to pay off the liability. So that is impacting the going concern. That if you're not able to pay off your liability, how are you planning to continue the business? You are into great debt, you have taken loans, you're not able to repay the loans. That means you will not be able to continue. Right? Ultimately what you're saying is that you have assets at a lower side. That means your assets are not sufficient enough to pay off your liability. Either it's a net liability condition or a current liability condition. In any case, you're not continuing, man. So that is one example. That yes, the going concern assumption is wrong. It is not adequate. Do you think that if there is a net liability position, the company will be able to continue? No. Next, we're talking about the loans. I think this entire screen, if it is in front of you, it will distract you. We'll go one by one. So we remove everything from the screen. Now you have in front of you the net liability position that we have checked, right? Next you have the loan. If your loans are not repaid, right? You are not able to repay your loans on time. You don't have money. You don't have finances to pay back your principal or the interest amount. Then how do we consider that you will be able to continue? You're not able to generate enough fund to pay off your loans, right? Or if the terms of the loans are not complied with. That means, okay, you're repaying it, but you were supposed to repay it on the 2nd of every month. But you're not able to do that. You are paying on 20th, 25th, as and when the money comes into you. Right? There are other conditions of the loan. You're not able to fulfill them. Right? They must have said that, okay, if you're not able to pay it on time, we'll charge this much interest. You're not even able to pay the interest. Right? There are other terms of the loan that was specified, but you are not able to abide by them. The loan says you will have to repay it in 2 years, but it has already been over 2 years and you're not able to repay it. Right? So that would be a condition that would give you a doubt that yeah, they will not be able to continue. They are not working well. Right? Next you have the creditors. The creditors do not support you. Now if the creditors are not supporting you, how do you plan to continue? And when will the creditors not support? They will only not support when you're not giving them money. They have given you goods on credit and you're not able to pay them back. So they have stopped giving you goods on credit. they have withdrawn their support from you. If the creditors have withdrawn, if the suppliers have withdrawn their support, I don't think you will be able to do your operations very well. How do you get the procurements now? There's nobody giving you on credit, you don't have enough cash, that is why you were going for credit, right? So then we think you go for a toss. Next, the creditors are not paid on due date. Every time there's a delay, every time the creditor has to keep following up, so please give us the money, please give us the money. You're not able to pay off any creditor because you don't have fund. And if that is the situation, they will, after some point of time, issue a petition for winding up. Then what do? You'll have to wind up. Then how do you say that you will go on and on for a year or two? How do you prepare your financials on the going concern assumption? You cannot do that, right? Next, cash on delivery. So if at any point of time you see that in certain company the creditors or the suppliers are now supplying their material cash on delivery. If you want the material, give us the cash in hand, take it away. When do they do that? When they don't trust the company. Because they know the company will not be able to pay, so they're not risking their stock. And if the company is not able to pay, the company is not operating well. So there is always a doubt that if they don't have cash at one point of time, they will not be able to procure. If they're not able to procure, they are not able to manufacture. If they're not able to manufacture, it's over. It's game over. Right? Next, negative cash flow. You're not earning anything, but your cash flow is going out, moving out. You have more expenses than your income. What do? If situation continues like this, you will not survive for long. You'll go bankrupt one day. Right? Discontinuance of dividend. You were a good company, you were giving out dividend every year or in alternate years or something, but for the past few years we have seen you have discontinued the dividend at all. We will not give dividend. Why will you not give dividend? Because you're not earning profit, you're not having enough to pay off the dividend, you're not able to retain anything, nothing. That means you're not working well, bro. You will be shut down very soon. The shareholders will withdraw their investment from the company. What do you do then? Right? The company goes for a toss. They'll file a petition for winding up if they want their money back. Then you have adverse financial ratios. Your financial ratios are going negative. You are not performing. Right? Then you may have substantial operating losses. Year on year, you are operating, you are doing everything, but at the end you have loss in your financial statement. And that is substantial operating loss. Maybe at times you are able to make up the loss by selling off some investments or the fixed assets, but that is how you are just making up the loss. But what about the operating loss? That is still consistent. If we look at the overall loss, maybe you are not suffering the loss, maybe you are coming to the break even or something, but if we look only at your operations, you are accruing loss year over year. That means you don't have the ability to continue. And the last point that we have is that they are unable to obtain finance for the new project. They want to expand because this project somehow is not working. They want to expand and get into new ventures so that they earn from there and support this venture itself. But no bank is ready to give them loan. That's because they have no creditworthiness in the market. If they are not getting loan from anywhere, that means that they are not performing well. How do we make sure that you will be going on for the next 1 year? You may shut down in the next 2 months because of lack of money. Right? So these are the financial indicators where you don't have the money, where you're not operating well. You're not making money, man. You're not making the profit. If you're not making it, you're going down. You are out of the field. You will not be able to play among the competitors. You are out. Right? The next segment we had was the operating conditions, operating events. What are they? Liquidation intended. The company intends to get into liquidation. The shareholders want to get into either voluntary liquidation or compulsory liquidation by passing special resolution. Or creditors, they want to wind up the company by passing a resolution. They have filed a petition in the court. That there is an intention to liquidate the company, or if it is the intention of the management to liquidate the company, then boss, you are not going. Then you are not supposed to apply the going concern assumption. You will have to prepare your financials on the liquidation basis. right? Now there are other situations where in the market they have emerged a lot number of highly successful competitors. Earlier your market was very good, you used to sell products, but now you have highly competitive predators. Then they are making good money, they are capturing the market, their marketing scheme is intensive, and you are not able to compete. That means slowly, silently you are moving out. So if this year you are not making money, you won't continue, you'll have to shut down. So that poses a great threat on your going concern assumption. Although you are making good, although you are in profit, no problem, but you will not be able to continue for long, because now your market has been taken over, right? Then situation of loss. If there is a loss of the key managerial person who was responsible to take the company to such heights, person who was the main person behind, main driving force behind the company, passed away or left the company, who is managing it? Nobody. It is working on its own, going for a toss. Why did he leave? Because he found that no, it's not able, that he's not able to pull the company anymore. It's in a disastrous position. So that is an operating indicator. If you're losing market share from your suppliers, market share to your distributors, market share in the market, your product used to hold 50% share in the market, now it has come down to 5 to 10% because the competitors have taken away the other market. What do? Right? You're losing customers, you're losing franchisees, losing license, losing the principal suppliers, everybody. You are not going to survive now. You may, but it is difficult. So that going concern assumption may not be appropriate, right? Then you have loss of suppliers, franchisee licenses going out, suppliers are going out, labor force are going out. How do you plan to do it? You have shortage of supplies, you're not able to produce now. Laborers, you're not able to pay all the laborers, they have backed out, they are going to some other company to work now. Otherwise also you're not producing. So these are operating impacts that if you're not able to operate, you will be shut down very soon, right? And now the miscellaneous and the other conditions. So if there is a non-compliance with the statute, here we go back to the labor law. You are employing child labor, which is against the statutory requirement. It is banned in the country. So the day they find it out, you are closed, you are shut, right? Next, uninsured or underinsured catastrophe. There's a big fire in your company, everything is burnt out, and if you look at the insurance, it wasn't insured. So what do you have now? Nothing. Bankruptcy is the only word for you. But even if you had insured 40% of the company. So even if you regain that 40%, with that money you're not able to run the entire company, set up the entire company and then run it. Gone, man. Last, legal cases. You have legal cases against you. There are many cases. People are filing suit against you and it is unlikely for you to win. And if you lose, you have a large amount of penalties to give. And if that cases, there may be some disastrous cases like the health hazard. The environmentalists, they have come up and they have said that you will have to shut down your company because you are posing serious damage to the health of the people. You are deteriorating the environment, right? And they have filed a suit in the court. Please shut this company down. And then you are now in a position to lose that suit. You will be shut down, right? And at last, some law and regulation are working against you. You were dealing into some product in certain state, and now that state bans that product. What do? Who will purchase your product? No distribution, it is banned. You have to shut down. That is the only thing. Like you, for example, if you were an alcohol mill in Gujarat, and now Gujarat is a dry state, gone for a toss, right? So that was just an example. Obviously you can support it out, you can supply it outside. It is just an example, hypothetical, right? That if there is any law and regulation that has come up in the country that bans your product or which is against your company in any ways, then you will not be able to survive. These are the other conditions, right? So with that, I think we've already covered the major part of this standard. This was the last part that we were supposed to cover, right? So for your examination point of view, friends, you have this last topic as the most important topic, right? This one, going back, events or conditions that may cast doubt about the going concern assumption. You've already been asked 3 to 4 times in the examination the same question. Sometimes you're asked only about the financial indications, sometimes you are asked about all the events and conditions, right? And this question has come up to 8 marks in your examination, right? So you'll have to learn them up, learn all of them, because otherwise you don't have a lot of things remaining in the standard. It is just that, okay, management prepares it on going concern basis, management evaluates the going concern, you check the going concern. If everything is going good, all well. If management considers an inappropriate assumption, you tell them this is inappropriate. Management rectifies it, well and good, give an EOMP. If management does not rectify it, adverse. Right? So these kind of things are very simple for you. That will be the case study, right, with 2 lines. And that you will be able to manage. But when it comes to writing about all the conditions that may cast doubt, examples, and if it is of 8 marks, you will have to write. It is not about copying the question or understanding from the question what is going on. No. You will have to keep each and every line in your brain. Otherwise, it is not coming out. That is why, if you look at your book, right, any book that you are following or the institute practice or the institute study material, it is not given in this format. It is just 1 or 2 statements. It is difficult to learn that way. Try clubbing up things. Yeah, we have 2 concepts of loan, 3 concepts about creditors, about the liability, adverse financial ratio, negative cash flow, right? This is how you go ahead. Because if you just remember creditors and loan, and you know that there are 3 and 2 points, you have 5 points on your paper, right? That saves you. So this is one way I found it easier to learn, and so I would suggest you that this is how you go on to learn it. These are just keywords, right? If you remember the keywords, you can explain it, no problem. But these keywords have to be there in your paper in order to fetch you marks. If you don't have these keywords in the paper, you will not fetch marks for that. And 8 marks is a big deal, big deal, right? So wherever you have a case study based question, right, it is easier for you to make the judgment and refer to the standard and give the points. Only mistake that you make is you may not be able to write the exact text from the standard. But no matter, even if you are writing the keywords over there and going with the format without writing anything too much out of the syllabus or anything, you will fetch marks. And if you're writing exactly what the standard says, bravo. But if you're writing in your own words, you may at times not get marks. You may score 30, 40, 45% marks in that question. So when it comes to these kinds of questions, it is a lottery for you, because there is a possibility to score. If it's an 8 mark question and you write all these points given in the standard, you may score 8 out of 8, no doubt on that. Because over here your language is not very important. All that is important is the specific points that you write. That yes, when you talk about the net liability position, you know that okay, it's talking about the net liability or the current liability position. Nothing else. You don't need to go on to explain it, because if you go on to explain it and these many points for 8 marks, you may take half an hour explaining it. Because you can go on and on this. So just remember, net liability position for loan either not paid or terms not complied. For creditors, either they do not support or they have come down to cash on delivery, or they are not paid on due date. Your cash flows are going negative, your operations are not working well, discontinuance of dividend, adverse financial ratio, substantial operating loss because of negative cash flow, inability to obtain finance on the new project. Try linking it, that your cash flow is negative and you are having operating losses. So the financial ratios are negative, adverse, and hence you want finance to sustain your business, but they are not even giving you finances. And since you are not having anything, you are going for a toss, you are not also able to pay your dividend. Prepare a story, learn it that way, right? So similarly, if you look at the operating thing, for loss you have 5 points: loss of key managerial person, loss of market share, loss of franchisee license, loss of suppliers, and loss of labor force. But if you look at it into your book, you will have each 5 separate statement. But if you link it, that okay, we are talking about loss, all the losses that you have apart from finance, they're all covered in operating. Slowly things will come up to your mind, right? And if liquidation is needed, that is one pervasive thing, right? And highly successful competitors. And for others, they are the major things: catastrophic position, no compliance with statute, legal cases are against you, and law or regulations are against you. So these are certain situations that would definitely keep you out of the market. Right? For financial and the operating portion, you can still improve on it. There is a possibility. If management has a good planning and good resources available for that, they can improve on the situation. They can regain their position in the market. But if something like this happens, labor law, you are out if you are employing child labor. If there is a fire and you did not insure your factory, gone. Nothing remains. Legal suit, you lose it, and that results in closing of the company. You cannot help it. Law and regulations are against you, so you're not able to operate at all. So these things are short closure. But if you look at the financial and the operating, they would still save you if you are able to manage it. Right? So try and understand things like this. That operating has 6 points, others have 4 points, combined 10, so financials have 10 points. That is how you remember things. Right? So that will be all for the lecture. Please stay tuned for the other lectures that are coming up. Subscribe for the channel. Post your comments if you have anything. If you have any questions, any queries to ask, please post it down in the comment. I will be very happy to explain it to you further in a detailed manner with examples. Right? So until then, until your next lecture, this is Abhinay Gupta signing off. Thank you. Bye-bye.